What does this tell us about what happened behind the scenes? What caused this?
That Wall Street's always exciting, especially in the midst of this. You know, I think there's a meta moment here. This is 10 years after Bear Stearns. So just to think about overall context, this is a Wall Street succession story. And it's been in private equity. We've seen firm after firm sort of transition and announce its succession plan. And now we're seeing it transition into Goldman, which is, you know, the ivory tower of Wall Street.
Max.
You should definitely listen to what Joel has to say instead of making these much more important. But what I'll add is that, you know...
Way to sell yourself, dude.
All right, no, I'm very important too. Very important too. So look, I mean, Lloyd Blankfein, you know, we think of as, you know, probably the most important chief executive on Wall Street, if not in some ways in corporate America, certainly one of the highest paid and longest tenured in finance. But the reality is, you know, Goldman, which is supposed to be this like supreme force on Wall Street, has not been killing it in the last couple of years the way that it did before the financial crisis. You sort of tend to think of Goldman Sachs as a trading powerhouse. It has not done all that well. And so if you think about the two co-presidents, you had Harvey Schwartz and you had David Solomon. David Solomon, in a way, represents banking and investment banking, and it's not hard to see why they went with him over a guy associated with not the greatest era in trading.
Well, let's take a look at that. Come inside the Bloomberg here. You can take a look at the stock price versus Goldman's FICC revenue. So the stock price is the white line, and the blue bars are FICC revenue. But I have a couple questions about that, because on the one hand, Lloyd Blankfein was standing behind the trading business, saying that it was cyclical, not structural. You also can't turn around the FICC business in 3 seconds. And also, when they announced their 5-year plan, it was Harvey that announced that.
Those are all great points. And I even have a kind of like a sadder point for Harvey, if he's watching, which is that first quarter trading is probably not going to be so bad. You know, he'll be gone by then when
and he gets this great little sign off, which is April 20th or whatever is going to be his last day, which is like right after they announce what happens Q1.
Oh, really?
And like with return of volatility, like Q1 could actually be really strong for them.
That's so Goldman Sachs that would happen. That's very sad. But, you know, there also is a bigger story, which is that in the wake of the financial crisis, a lot of Wall Street firms really kind of, in some ways that mattered, changed who they were. And Goldman Sachs is the firm, if you were to think of the 6 big banks in the U.S., you would pick Goldman as the one that really decided to stick to its knitting, to be the risk-on, risk-taking powerhouse. And that hasn't been the wisest strategy in the last couple of years. You know, Wall Street still takes risk. At Goldman Sachs, you know, for all we know, we could be sitting here at this table in a year from now talking about Goldman taking all sorts of risks. But at least right now, the way things stand, it wasn't the best strategy for the past year.
And it really looks like the bet on the future. It's going to be more investment banking, more finance, less trading.